IndusInd Bank started the fiscal on a strong note with robust growth in advances, stable interest margins, steady core fees, and comforting asset quality with slippages largely from the restructured book. With the stock underperforming Nifty as well as Bank Nifty in the past 3 months and trading at a reasonable valuation, we see scope for further re-rating. The bank in the past had faced multiple challenges ranging from asset quality stress in corporate book, run-on deposits following the Yes Bank fiasco, and in the more recent times, the whistleblower allegations on procedural lapses in the microfinance book. Recent investigations do not pertain to the bank, and therefore, with a high-yielding book dominated by vehicles and microfinance, steadily improving liability and waning asset quality concerns as the economy improves, we see sustenance of its high interest margin and expansion in return ratios. Acceleration in loan growth coupled with steady interest margin supported the core earnings that were dragged down by tepid show from Treasury on rising interest rates. The key earnings kicker came from lower provisioning on improved asset quality. Reported gross and net NPA were almost flat at 2.35% and 2.67% respectively. The provision cover on NPA is at a comfortable 72%, while slippage to NPA went from 2,088 crore rupees to 2,250 crore rupees QOQ. The point to note is that a large part of it was driven by restructured book with slippage from the standard book actually declining. Consequently, the proportion of restructured assets has seen a sequential decline from 2.6% to 2.1%. The good news here is that the bank carries over 3,000 crore of contingent provision principally to cover for the slippage from restructured book, and it's already utilized 325 crores from the same during the quarter gone by. Overall provision on all counts is 3.4% of loans and 141% of gross NPA. The special mentioned accounts with overdue principal and interest from 30 to 90 days also declined sequentially from 59 basis points to 49 basis points. On improving outlook for vehicle and microfinance segments and the complete overhaul of corporate book with better rated assets, the bank expects credit costs to remain in the range of 120 to 150 basis points of loans in FY23. With close to 4% sequential growth and 18% YOY growth, loan growth is back to the bank's intended trajectory. In fact, in the quarter gone by, vehicle finance witnessed its highest quarterly disbursement. Corporate books surged as well, aided by smaller corporates, and other retail assets also saw traction. Growth in MFI was impacted in the earlier part of the quarter due to regulatory changes, but since then has picked up and has had its highest Q1 disbursement as well. The gems and jewelry portfolio was subdued on account of Russia-Ukraine conflict, but it is expected to pick up. Although the growth engine is firing full throttle, the good news is the YOY growth in risk-weighted assets at 11%, which still lags the loan growth, pointing to improved quality of incremental book. The bank has also been maintaining industry-leading net interest margin that has incidentally improved by 10 basis points sequentially in a quarter marked by volatility. However, IndusInd Bank has seen over 3% sequential and 13% YOY growth in deposits and has a comfortable credit-to-deposit ratio of 82%. The bank nevertheless managed to grow its low-cost CASA well that surged by over 16%, driven by more than 19% growth in savings accounts deposit. The share of CASA stood at over 43% from 42% in the year-ago period. The key area for improvement remains the retail deposit share of 41% that has a lot of catching up to do in the coming years. The bank is eyeing 45% in the near term and 50% as a medium-term target. Like most peers, IndusInd Bank is also spending on technology and people to capture market share at a time when shadow bankers have been rendered weak. Now, this coupled with lower trading gains resulted in mild rise in the cost-to-income ratio. IndusInd's comfortable capital adequacy at 18.14% with a CET1 ratio at 16% prepares the ground for a strong growth trajectory ahead. In the context of growth outlook, valuations look undemanding, leaving further room for re-rating. Now, of course, a key risk to watch will be an economic slowdown, which could impact earnings as well as the asset quality.